anytime we're talking about concentration risk, it's, maybe it's a particular stock that you hold that's a larger percentage of the portfolio relative to the rest of your assets that are maybe more diversified. I think that company stock in particular is
Your employer
more
stock.
unique. Yeah. So
Yeah.
like at the company that you currently work for, because it's not only like you've got a whole bunch of company stock potentially, and maybe that makes up whatever percent of your portfolio. We'll talk about, how do we think about knowing how much is too much versus the right amount in a bit. You're also depending on that company for your income too,
Benefits.
and benefits. And, I can't make any sort of prediction about like what happens, but just imagine a scenario where things aren't going well for the company. So the stock price is way down. You have a
Yep.
whole bunch of that company stock that's worth a lot less than it was before. And then you get laid off because the company's in a hard time. And so
Restructuring. Yep.
it's not as simple as, there's lots of rules of thumb out there of like, oh, have, less than 5% or 10% or whatever in any one stock. And it's like,
It's not that clean. Not
okay.
that clean.
And like rules of thumb are like not unhelpful, but like they're really just not great for like an
Yeah.
individual situation, right?
Right.
Which is where we can really bring a lot to the table. But
Right.
I just kind of, you almost have to throw that out the window when it's company stock because there's these additional layers too. So, we can talk about, you know, depending on what the money's for, right? The right things to do with that. But I'm curious to hear, the conversations that you've had with folks of like, all right, I have this company stock. It's something that's kind of built up over time, and
Yeah.
maybe it's kind of looked at as like found money or just like
Yeah.
over here, it's this thing. And like, what are some of the things that you've heard people say like, oh, I have it over here and I'm going to use it for X that you're like,
Yeah.
oh, is like,
Yeah.
is that the best
Is that
place
the
to
best
hold
place?
that,
Right.
So any stories you can share there, I think would be really
Sure.
interesting.
Yeah. The number of folks we talk to are just like, it's just, I've just gotten it given to me, or I, just bought it through my ESPP and I just let it sit because I didn't know what to do with it. Or my mentor, who had been at the company for 30 years before I got here, said, leave it in the stock. It was the best thing I ever did. Well, yeah, that was back, I could get into the company 30 years ago to where it is
Hindsight's
today.
2020.
Hindsight, exactly, right? Like that doesn't talk anything about our current situation in the future. So, and it's a lot easier. A lot of it sometimes comes down to fear and not wanting to address it and just letting it sit, letting it sit, letting it sit. And hopefully the stock does well. And then you're sitting at it and you're like, oh, I could just pull from it for XYZ reason, a new deck, first home purchase, whatever it might be. But there's not a whole lot of intention behind it. And so one of the most common questions I have to ask folks is, hey, we save every dollar for a purpose, right? We're saving a dollar to pay for retirement, to pay for kids' school, to pay for a new car, something. A lot of times equity comp is just kind of like a catch-all, like you said, like I'll use it for something at some point down the road, but there's not an actual, what I'm going to call liquidation strategy or a plan for how we pull out from that position. Whether it's, I'm not saying you need to do it now, like it has nothing to do with like you said, concentration, how much we have. It's just at any point, when are we going to use this and how are we going to tap into it? And the number of blank faces I get of just, oh, I've actually never really thought of that. And they're like, well, what's your coming goals? And they're like, well, I want to buy a house in 2 years. And I'm like, okay, where's that money coming from? They're like, I'm planning on pulling it from the company stock. And I'm like, all right, do we think that's the best place for it to be? And they're like, well, where else should I put it? And so it's not that that a lot of folks necessarily want to have it all in their company stock. They just don't know a better place to put it or how to be thinking about it. And we have to have those conversations a lot.
Yeah, I think a lot of it is inertia too.
Yeah,
Like if,
big time.
let's say I've got $500,000 in company stock that I've accumulated over whatever, various equity comp plans or ESPP. And, that's something that, by the way, like you've earned, like it's not just money that was given
you've
to
earned
you.
this
That's
money.
part of your
Yeah,
compensation, right? So it's not
100%.
found money that was just
We already
gifted
talked
to
how
you,
it's getting taxed. Like it's getting taxed. You earned this
Yeah.
money. Yeah.
But like if I have, so, okay, big picture beyond company stock for a second. If I'm sitting down with a client and they're like, hey, I want to buy a home next year and I want to put down a 20% down payment or pay for all of it in cash, whatever. I've got $500,000 in cash. All this is going to go towards a home purchase in a year. I would never say, hey, let's invest it for a year
Yep.
and
Let's roll
try
the
to make
dice.
more,
Yeah.
you know,
Yeah.
because like, cash is not super exciting, but like, up 3% is better than down 50%,
Right.
whenever you need that money. And so
Yeah.
I wouldn't even invest it in bonds in that case because bonds still have risk too. 2022 was the worst year ever for bonds, and stocks and bonds are both down equal amounts that year. And so I definitely would not say, okay, let's put that $500,000 into a single stock.
Yeah.
And I definitely would not say, let's put that $500,000 into a single stock that also is the company that you work for. And so I don't think anyone thinks that I'm crazy for saying that.
Right.
I think it's inertia of like, well, I would never take $500,000 to cash and buy company stock. It's like, then why would I have $500,000 in company
It's already
stock
there. It's
that
already
was
there.
just there
Yep.
for this thing that's a really near-term expense? Or like as
Yep.
my emergency fund, I would never say, hold your emergency fund
Right.
in a individual stock at the company that you work for, you know?
Right.
And so I think just taking a step back and thinking about it that way, I found is really helpful. And people are like, oh yeah, okay. Like that makes a lot of sense. Like in my stock price, it has moved around a ton. And like, I can't tell you what's going to happen in the stock market really ever. Right?
Yeah,
We have
yeah,
some
it's
very
clear.
educated guesses and we can
Right.
run different, simulations on potential outcomes, but it's pretty unhelpful over a really short-term period of time of
Right.
6, 12 months, or even like 3 to 5 years. I can't even do that with an individual stock because individual stocks don't behave like a fully diversified portfolio in the market. And so I just think, and I totally get it. It's just, hey, I've acquired this. Maybe I'm nervous because I don't know what the tax implications are going to be, or it's easier just to like let it do its thing. I'm like, I'll get it when I need it. But I guess it's one thing if it's like, I don't have a specific purpose for it other than like, maybe it's like long-term retirement. Like, okay, well then like maybe it can make sense. If it's a near-term expense or an emergency fund, it should absolutely not be in company stock. And like at a certain point, I don't care what the tax implications are, you think about like, well, if I hold on to it for another like 12 months, it'll be a qualifying disposition, a better tax treatment. And it's like,
Is that worth the
and
risk?
it could be worth a lot
Yeah,
less.
is that worth the risk?
Are you going to be celebrating that you paid less to Uncle Sam, but you have less money in your pocket? But like, man, I really stuck it to the government. Like,
came out with less money, but I showed them.
Yeah.
Right?
And it's just like, you can't let the tax tail wag the dog.
That's what we're saying here at Plancorp. Yep.
And so it's just making sure that like risk, your ability to take risk with that company stock and your willingness to take risk are both really important. And that's
need to take risk, which is kind of what we'll go into here a little bit with like, how does it map into our goals as well?
Right. Yeah. All those things are important. Those are just part of any good investing kind of philosophy as you're thinking about like decisions that you're making with your money and how investments kind of involve that. Like it's even more important with an individual stock at the company that you work for.
And it's kind of, in my opinion, to wrap it all up on the concentration risk side of things, it's different for each person. Yeah, there's a rule of thumb, but like it's more about acknowledging the risk that you're taking.
Mm-hmm.
A lot of folks don't understand fully the amount of risk they're taking. And like you said, inertia, out of sight, out of mind, whatever it might be. If you're somebody who's like, I am the most bullish person on Acme Corporation to the moon, I want 50% of my net worth in it. Like, yeah, from a risk perspective, we're going to sit here and we're going to say, hey, maybe you don't need to do that, or maybe you shouldn't do that. But if you acknowledge it and understand it, nobody can really tell you that you're wrong, because at the end of the day, it's your money that you've earned. But it's always nice to have a partner who's making sure you do fully understand those risks, fully understand how much of your financial future is tied up into this, and that you're not overlooking any of those risks that could hit you at some point down the road.
Yeah, and I think there are some layers I'll add in here to kind of help with those decisions around your willingness and your ability to take risk. Number one that I think is really important is that we hate losing twice as much as we love winning.
Oh, yeah.
So if I, whatever the amount is, I've got $200,000 of company stock, and I'm going to have equal but opposite feelings of a 20% increase in the value of that relative to a 10% decrease. Obviously, I'm going to be happy in one of those scenarios and not in the other, but I'm going to feel those feelings equally. And so you think about like FOMO, or like, I just don't want to, what if the company stock price takes off from here? Like, I think that's helpful context that we hate losing twice as much as we love winning. And I've just seen people really beat themselves up over like, God, I should have done X, Y, Z. And it's like, okay, but like also be fair to yourself, because now we can look back and see how that turned out. This is true of financial planning and investments in general, but certainly with company stock, like you got to make the best decision you can without having all the information you need to do it. And that's just kind of the uncertainty we have to live with in the kind of work that we do. So that's number one. Number two, especially if you're a company that's a larger company and maybe it's a large cap stock, and it's like, oh, I'm at fill in the blank company. Like they're not going to go out of business and they'll be around forever. And like, maybe they will, but I think it's really insightful. There's a study done by, I think it's JP Morgan. It's the agony and the ecstasy.
Oh yeah. Yep. Very popular.
Really good. But the highlight of that to me was from 1980 through 2020, 40% of all stocks ever listed in the Russell 3000, which is the kind of the benchmark for the total US stock market. 40% of those individual stocks lost 70% or more in value and never recovered.
Yep. Never came back.
Okay. So like, don't say not my company,
It
even if they're
very well
here.
could
Right.
be,
And there've been some
right?
very large companies that have gone under, and like,
Yep.
it's not because like, maybe it's not because of like fraud or
Yeah.
mismanagement
Right.
from the, executives. It could be changes in regulations
Exactly.
or,
New technologies, new advancements in the field.
totally. And
Yep.
so like, or just like things that have nothing directly to do. Like when interest rates went up in 2022, tech stocks got smashed because people weren't willing to pay the valuations with interest rates being
Right.
high. So like that had nothing to do with your tech company.
And what the work it's doing and all that kind of stuff. It's
Yeah.
other factors.
And so like you need to be eyes wide open about that. And those kind of get to, your willingness or like making sure that you understand the risk that you're taking. And I think another piece of that too that we really provide a ton of value on is like, what is your ability to take on that kind of risk? Like no matter how excited or bullish you are about the company stock, or you're like, I'd love to have half, I'm probably going to look at you and think like, my God, are you sure? Like that's a lot. But, we everything that we do is built off of what we call the financial independence analysis. And it's just like think of it like it's a retirement plan, but there's more to life than retirement. It's like your whole life, right?
Plan.
It's like
your
today,
life plan, yeah.
right? Whatever percentage of your portfolio is in company stock or whatever that dollar amount is, like, can I take that and knock 70% off the value of it and assume a 0% return forever and your plan still works? If I can, then I might still think you're crazy, but if your eyes wide open and you're like, cool, cool, I'm on board with that. And so that's why I just think rules of thumb are so hard, because for somebody, 10% of their portfolio could be too much.
Yep.
Because maybe they're nearing retirement, like they don't have a lot of time to recover if that happens, and it's
or
like
they're retiring early, can't tap into their 401k yet. They're going to need to tap into this
Right.
instead to bridge that gap. And
Right.
you just and to cut you off there, you just summarized why you need to have a partner when this becomes a significant portion of your total net worth, your total financial picture.
Mhm.
Rules of thumb, Googling it, using AI, whatever it might be, those are all great things to kind of learn. It's not always the greatest to actually apply it into what's going on in your life. And even if it is just having a conversation, sitting here and having a back and forth with, why Derek thinks I'm crazy for wanting to hold 30%. Derek can show in and give me advice on why he thinks that. And maybe there's reasons why outside of just the numbers, outside of the rules of thumb, that go into those pictures. And I might feel that and understand that. And having that partner is honestly invaluable.
Yeah. Yeah. And I think also there's emotion involved with any kind of investing, but especially when it's the company that you work for. Like, maybe you feel like, and this is something else we get into too, like, well, if I sell, that makes me like a bad employee. Or I just, I have so much faith in the company, and like the stock price is going to go way up from here, and like I'm working hard, and like, and that's, look, that's the purpose of equity comp, is to align your financial interests with that of the company. And that's not a bad thing. I think
that's a great thing.
I'm a shareholder at Plancorp. Like we have lots of shareholders here, and equity comp is super popular. I think that's a fine. I'm not criticizing that. I think it can be great. If you're not intentional, though, it can like really cause some big problems. And if you're a client that we're working with, or I'm having a conversation, it's like, look, I understand that your willingness to take risk is there. I would question the ability to take risk, because if this happens, it would be a pretty big financial setback.
Yep.
And if you're like, okay, but I still want to do that, then it's like, all right. To what you said earlier, like it's your money. You can do whatever you want with it. I want to help you understand then what adjustments would need to be made to your plan, your future life, if that does happen. And all of that kind of comes back to, again, just being eyes wide open about the risk that you're taking. Because at the end of the day, like there's so much uncertainty involved with this, especially with company stock.
If you're somebody who's beginning to develop more and more equity comp as a portion of their income and their net worth, and you think you might need a partner, the stress is becoming a little more than what you want to take on. You want to offload some of that. You're looking for somebody to just bounce ideas off of, help with implementation of any of the things that we talked about on any of our sessions together. Go to plancorp.com, You can request a no obligation, no cost consult with a member of our team who specializes in equity comp. They can walk you through the areas we think we can provide value, see if it matches up with what you're looking for, and decide if it's a really good fit for helping you out with guiding you through your future.